Where is market psychology on the chart? Spot the game-changing point. You're not losing because of bad trades. You're losing because you don't understand the game you're in. Most traders look at charts and see candles, prices, and lines. But what if I told you every candle is a vote, every volume bar is a scream, and every price zone is a battlefield of human emotion? This isn't about guessing tops or bottoms. It's about understanding what the crowd is feeling right now and positioning yourself before they even know what hit them. In this video, you'll learn where real market psychology hides on the chart and how to spot the emotional turning points before the trend even begins. Chapter 1. Market psychology doesn't hide in indicators. It lingers on the chart as a trace of emotions. If you've ever felt anxious watching the market rise while you're stuck on the sidelines, or frozen when prices fall and you're too afraid to sell, then congratulations, you've entered the biggest game in finance, the game of emotions. The scariest thing in the market isn't losing money. It's losing trust in your own reasoning. Most traders approach charts like a game of guessing price direction. They search for buy-sell signals, draw support-resistance lines, apply RSI, MACD, Bollinger Bands, and think they're doing technical analysis. But in truth, they're just seeking certainty in a place where certainty doesn't exist. And because of that, they always react slower than smart money. Because true technical analysis isn't about drawing. It's the art of reading crowd psychology through price behavior. Market psychology doesn't live inside indicators. It lives in the question, what are others thinking, and what will they do next? Think of it this way. Every candle, every price zone, every spike in volume is the result of thousands of people acting. And behind each action is an emotion. Euphoria creates breakouts. Panic triggers sell-offs. Greed holds the price after a drop. Expectation drives prices ahead of the news. So the question is, how can you see these emotions on a chart? Not by counting Elliott waves or spotting RSI divergence, but by putting each price move in context and asking, who is acting and why? Example, a strong green candle appears after days of sideways consolidation. The price closes at the session high. Volume spikes. But what made buyers pour in so decisively? Maybe it's good news. Maybe smart money finished accumulating and decided to push the price up. Whatever the reason, that behavior reveals one thing. Emotional consensus has reached a tipping point. And when emotions explode, trends begin. Or the opposite. The price is rising. You notice increasing volume. Suddenly, a long red candle slams back to a previous support zone. What's the emotion here? It could be a signal that investors are growing doubtful. Some big players might be taking profits. But if the next day, price bounces back strongly with high volume, this is no ordinary pullback. It's a test. Can the crowd's psychology withstand the pressure? Great technical analysis isn't about predicting every top and bottom. It's about understanding the emotional meaning behind each move. A chart isn't a treasure map. It's a diary, recording the fear, hope, and ambition of thousands of people. Those who look at charts as lines crossing lines will always be late. Those who read charts as emotional battlegrounds will stay a step ahead. You can see it in shakeouts, where retail traders panic sell and smart money quietly buys in. You can see it in sideways accumulations, where the impatient walk away and the patient stay. You can see it in breakouts, where the majority rush in, but those who understood the psychology already took their positions. And here's a truth few will tell you. Charts don't lie. Only your emotions while reading them make you wrong. When you look at a chart and feel, this looks bullish, this must be a breakout. Pause and ask, what is the crowd feeling right now? Do they believe they're right, or are they doubting themselves? What would smart money do if it saw the crowd euphoric or afraid? That's how to read a chart like an analyst. End of chapter 1. The chart doesn't need your prediction. It needs your ability to feel the emotions behind every candle. In the next chapter, you'll learn how to identify the 3 price zones that most clearly reveal market psychology and how to use them to anticipate crowd behavior before they act. Are you ready? Chapter 2. 3 price zones that expose market psychology and how to read them like a true analyst. If a chart is the emotional diary of the market, then there are 3 key chapters in that diary you must memorize. These 3 price zones don't just reflect behavior, they reveal the true inner world of the crowd, where emotions drive actions most clearly. And once you can see that, you will no longer be a follower of the market. 1. The accumulation zone, where patience speaks. When the market moves sideways after a sharp drop, many think it's dead. The price doesn't rise, doesn't fall. But to a market psychology analyst, this is a goldmine. Picture this. Weak hands have already panic sold. Big players aren't rushing. They quietly accumulate, keeping prices flat, causing most people to lose interest. Volume dries up. The news stops paying attention. This is the calm before the storm. It's where the majority lose patience and walk away. The observant recognize this. If, after a steep drop, the price refuses to fall further and instead moves sideways, it means the sellers are exhausted. And smart money is quietly accumulating. Key insight here. A positive market psychology isn't shown by price rising, but by price refusing to fall. 2. The breakout zone, where emotion ignites. When the price breaks out of the accumulation zone, people finally notice. News headlines pop up. Forums light up. Those who once doubted begin to feel regret, and FOMO kicks in. This is when emotions are most activated. But you must clearly distinguish, is it a real breakout or a psychological trap by big money? A true breakout comes with high volume and a solid close above resistance. A false breakout? Low volume, a brief push above resistance, then a sharp reversal. Newbies tend to buy during breakouts, thinking something big is starting. But the ones who understand psychology were already in position, and now they're getting ready to sell. Important to remember, a breakout is not a signal to join. It's a signal to analyze where the crowd is being led. 3. The pullback zone, where emotion gets tested. After a breakout, The market rarely moves in a straight line. It usually pulls back to test previous levels, and this is the most difficult psychological exam. Those who bought start asking, "Did I mess up? Why is price falling?" Those still outside wait for a deeper dip before jumping in. This is the zone of doubt, hesitation, and fragile belief. But in this sea of uncertainty, the smart investor reads price structure. If the pullback is shallow, volume is low, and selling pressure is weak, smart money is likely luring you to sell cheap. On the other hand, if the pullback is deep, selling is strong, and volume spikes, it may signal a real reversal. That's why the pullback zone demands your sharpest focus. Don't follow emotion, watch how price reacts. That's where market psychology speaks loudest. The difference between price watchers and price readers. Those who only watch price think, "Price up buy, price down sell." But those who read psychology ask, "Who's buying? Who's selling? What is the crowd feeling? Is smart money moving in the opposite direction of the herd?" The three zones, accumulation, breakout, pullback, are the clearest points where emotion is exposed. If you train yourself to hear the crowd's voice through price behavior, you'll act opposite of them, but aligned with the big money. End of Chapter 2. A chart is not just a picture. It is a silent conversation between human emotion and real capital. You can study indicators. You can learn candlestick patterns. But if you don't learn how to read emotion through price and volume, you'll still be a step behind in a game where the ones who truly understand psychology have already moved ahead. In the next chapter, you'll be guided to a powerful skill: how to analyze candlesticks plus volume plus price location to detect emotional turning points, even before the trend reveals itself. Don't miss it. Chapter 3: Price, Candles, and Volume, the Language of Market Emotions. If you've ever felt like you entered a trade at the right technical spot, but the market suddenly turned against you, it doesn't mean your method is wrong. It means you haven't yet learned to hear the real voice hidden beneath price, candles, and volume. Price is the outcome. Candlesticks are the expressions. Volume is the intensity of crowd emotions. These three elements are the invisible language the market uses to narrate what's truly happening. And in this chapter, you'll learn to read, not guess, market sentiment through concrete signals. 1. How candles speak to you. A candlestick doesn't just show open and close prices. It reveals how the battle unfolded during the session. A strong lower shadow after a deep drop, long lower wick, shows there was selling pressure, but buying strength appeared, pushing prices back up. This signals a rejection of lower prices, a subtle shift that could be the beginning of a reversal. A small-bodied candle with long wicks on both ends, doji or spinning top, often appears when the market loses direction. This is when both bulls and bears are hesitant and emotions are waiting for a catalyst. A strong bullish candle, large body, closing near the top indicates strong buying pressure. The crowd is getting excited. But if that strong bullish candle has low volume, it could be a trap, a fake pump by smart money. Conversely, a strong bearish candle with low volume might not be scary. It may not reflect real selling force, just a psychological scare tactic. Key takeaway: a single candle means nothing by itself, but when placed in context, it becomes a whisper from the market. 2. Volume, the loudness of the crowd's shout. Volume doesn't lie. While candles can be deceptive, volume tells you. How many people are acting? Are they acting with conviction? Is this real consensus, or just a fake move? When price breaks a key level with strong volume, that's confirmation of strong belief. But if price breaks out with low volume, be suspicious. It could be a trap, with smart money luring you in before reversing the move. Example: a breakout above resistance with strong bullish candles plus rising volume over several sessions. Crowd is joining, euphoria is rising. But if after the breakout, price goes sideways and volume drops, buying pressure is fading, enthusiasm is not sustained. And that's when you must ask, is this a continuation? Or is it the calm before a confidence collapse? 3. Price position, the story's context. Price means nothing if you don't know where it stands on the bigger picture. A bearish candle at the top of an uptrend says something very different than the same candle at the bottom of a downtrend. At accumulation bottoms, rejection candles, long lower wick, plus rising volume equals big money quietly buying. At distribution tops, doji candles plus sudden volume spike equals growing doubt, a likely reversal. The key question is, don't just ask, is this a nice candle? Ask, where did it appear, and what is the crowd feeling right now? 4. Combining the trio, candle, volume, context. This is how to read market sentiment like a true analyst. Situation, sentiment, interpretation. Strong bullish candle plus high volume plus breakout above resistance, crowd is euphoric, confirmation present. But smart money may begin distributing. Rejection candle plus high volume plus at support zone, strong demand. Pessimism is being challenged, high chance of reversal. Bearish candle plus low volume plus after long uptrend, weak selling. Could be a shakeout, testing new traders' confidence. Each combination tells a different emotional story. And when you spot these signals, you no longer have to guess the market. You read it. End of chapter 3. From chart viewer to emotion reader. Charts are no longer just technical toys. They're maps of human emotion, filled with fear, greed, doubt, and hope. A skilled analyst doesn't ask, where will price go? They ask, what are people feeling right now? And from there, they act before the crowd reacts. In the next chapter, you'll learn about recurring emotional patterns on the chart and how to use them like a compass to detect the next trend before it fully forms. Chapter 4. Repeating patterns, the traces of crowd emotion. There's a truth few people notice. Markets don't repeat exactly, but human psychology does. Crowds are always caught in the same emotional cycle. Fear, hope, greed, panic, regret. And this very cycle creates recurring price patterns on charts. Not because the market has a plan, but because people don't change. They react the same way, whether in 1929, 2008, or 2025. 1. What are patterns and why do they matter? Price patterns are not digital magic tricks. They're the result of collective emotion, repeating over time. A symmetrical triangle is hesitation waiting to explode. A double top is lingering hope before it shatters. A head and shoulders is the classic setup for distribution, where smart money exits quietly. If you study patterns as formulas, you're learning it wrong. Study them as psychological maps, where the crowd fools itself again and again. 2. Patterns and the psychology behind them. Symmetrical triangle. Price narrows. Buyers and sellers converge. Emotion, doubt, anticipation, rising expectations. Rookie traders think, big move coming. Smart money prepares silently, no guessing, just positioning. Double top / double bottom. Double top. The crowd clings to hope after the first drop. When price retests the top, they think, this time it'll break. When it doesn't, trust collapses. Panic selling erupts. Double bottom. First comes fear, then doubt. But when price forms the second bottom and rises, it signals that negativity has been exhausted. Head and shoulders, the signature distribution pattern. Left shoulder, price climbs, optimism builds. Head, highest peak, euphoria. Right shoulder, weaker peak, smart money is already leaving. While the crowd dreams of 2x targets. Those who read emotion have already exited in silence. 3. The scary repetition of emotions. Think back to recent hype markets. Crypto 2021. AI stocks 2023. Meme stocks 2020. All followed the same emotional cycle. No one cares. Early excitement. Confirmation. Greed spreads. FOMO kicks in. Peak euphoria. Doubts arise. Panic selling. Despair. Hope returns. This isn't theory, it's real life on the charts. And if you look closely, price reflects each step of that cycle. For the patterns aren't for guessing, they're for reading. Many traders try to guess. Will this pattern break out? Is this a fake out? What's the target? But those who read market psychology ask, what are people expecting right now? Who's getting trapped here? Is smart money pushing the price or setting a trap? You don't need to be good at guessing. You need to know who's on the other side of your trade and how they feel. 5. The mindset of an analyst, not a gambler. Beginners look at charts like a slot machine. Analysts look at charts like a map of human emotion. Each pattern is a play, with a full cast. Rookie traders. Long-term investors. Smart money. Trading bots. News and media. If you can step back and observe without bias, you'll start to see clearly. Is this the scene where the crowd is blindly euphoric? Or where they're giving up in despair? End of chapter 4. The market is a theater, and you are not the audience. From now on, don't see patterns as tools for entries. See them as warnings. Where is crowd psychology right now? Every major reversal starts with a simple pattern. But behind it is a subtle psychological shift only sharp observers can spot. In Chapter 5, we'll explore how to connect patterns with volume and price context to build a clearer edge and know when to stay out and when to strike. Chapter 5. Connecting Volume, Price, Patterns. The Key to Reading Market Psychology. In the previous chapter, you learned that chart patterns are emotional footprints of the crowd. But if you only see shapes without reading the story inside, you're still guessing. The market isn't just a picture. It's a real-time story, and to read it, you must connect 3 elements: volume, price, context. 1. Volume doesn't lie. When you read volume, you're hearing the market speak. I care about this price level. I'm attacking. I'm backing off. Low volume, the market is waiting. Sudden volume spike. Someone has made a move, and it's never random. Remember this. Every breakout without volume is an illusion. Every dump with huge volume is fear screaming out loud. Volume is collective emotion, and it cannot be hidden. 2. Price is the result. Volume is the cause. When price rises while volume drops, that's weakness. When price pulls back slightly but volume is high, someone is selling aggressively. It's like a car speeding up, but the engine's overheating. You might be heading toward a major breakdown. Example: a strong bullish candle with low volume might be a trap. A violent shakeout with massive volume could be a potential reversal point. Volume helps you separate real from fake. It shows you who's in control. 3. Pattern plus volume equals the full picture. Let's revisit the triangle pattern. If you see price narrowing within a triangle while volume also decreases, the market is waiting. When the breakout comes and volume surges, that's confirmation of the winning side. But a weak breakout with low volume, likely to be pulled back. A head and shoulders pattern becomes more reliable when the right shoulder forms on lower volume than the left, buying strength is fading. The neckline breakdown with high volume confirms the crowd has surrendered. 4. Context is the foundation. Without it, signals are meaningless. Never analyze volume and price in isolation. You must understand their context. Is the market trending or sideways? Was major news just released? Is this price level a key support/resistance from the past? Example: a strong price rally in an uptrend with high volume, trend continuation. Same rally during a downtrend could be a bull trap. Context helps you see who's getting trapped and who's setting it up. 5. Mindset exercise. Read the chart as a story. Imagine this. A price zone gets tested 3 times but doesn't break. Each test comes with high volume. Then you see a long lower wick candle with massive volume. Don't enter yet. Ask yourself, who's trying to defend this level? Why is there strong support here? Is this smart money accumulation or the last stand before collapse? You don't need to predict the outcome. You just need to understand the play and choose your role wisely. 6. Mastering the market means mastering the connection. Don't study volume, price, and patterns as separate topics. They're connected, and only when you see that connection will you truly understand market psychology. Just like the human body. Rapid heartbeat, volume. Pale face, price drop. Dry lips, fast breathing, bad news, context. A doctor doesn't guess each symptom. They read the whole picture and diagnose accurately. You must do the same. End of chapter 5. The market speaks loudly, but are you listening the right way? Most traders don't fail because they lack tools. They fail because they don't know how to connect the dots. Volume, price, patterns, context. These aren't just indicators. They are the language of the market. Learn to understand that language, and you'll stop guessing. In Chapter 6, we'll dive into the decisive move, reading psychology in each phase of a trend, and how to enter without falling into the crowd's traps. Chapter 6. Reading Market Psychology Through Trend Phases, the True Analyst's Decision Point. You've come a long way, from reading candles, understanding volume, analyzing patterns, to connecting all signals on the chart. Now we reach the final chapter, reading the market psychology through each phase of a trend and making precise decisions. Remember, every trend has a beginning, a climax, and an end. Each phase reflects a different emotional state of the crowd. And smart money is always one step ahead. 1. Accumulation phase, where emotions fall silent. This is where everything seems meaningless. Price moves sideways in a tight range. Volume gradually decreases, liquidity dries up. Most traders quit, feel bored, or stop caring. Crowd psychology, impatience, doubt, neglect. Smart money behavior, quietly accumulating, leaving no clear trace. The chart looks like a desert, silent, barren. But this is fertile ground for the explosion to come. A skilled analyst doesn't fall asleep here. They watch for price positioning, unusual volume, fake shakeouts. 2. Breakout phase, excitement starts to rise. When price breaks out of the accumulation zone and volume spikes, retail traders start to notice. Positive news appears, social media starts buzzing. Crowd psychology, hope, excitement entering trades. Smart money, already in position, now triggering the crowd's FOMO. A breakout candle with high volume closing above resistance, this is a strong signal. But if you're chasing here, you're already late. A good analyst entered during the accumulation phase. Now, they just observe and wait for a pullback. 3. Strong uptrend, blind belief takes over. Price keeps rising, volume remains high, and people start to believe. This time is different. The market won't stop. Forums, TikTok, YouTube are flooded with experts and rosy forecasts. Even minor pullbacks are seen as buy-the-dip opportunities. Crowd psychology, overconfidence, obsession, ignoring risk. Smart money begins distributing, selling gradually to the crowd. You'll notice, price keeps rising but volume starts to drop. Sudden spikes that quickly get sold off. Old resistance zones return with heavy volume, a sign of unloading. Backhand index pointing right, this is when a wise analyst doesn't get greedy. Backhand index pointing right, they start taking profit, lowering risk, and looking for reversal signs. 4th, peak phase, the trap of greed. Price hits new highs. Good news keeps coming. Everyone says, now's the time to buy. But this is when volume rises, not due to buying, but because of selling. False breakouts emerge, price breaks a high, then reverses sharply. Long upper wicks with heavy volume appear repeatedly. Crowd psychology, greedy, reckless, ignoring warnings. Smart money, completely exits, leaving traps for weak hands. Backhand index pointing right. If you're still holding your full position, you're in a minefield. Backhand index pointing right. The skilled analyst sees the collapse coming and exits early. 5. Distribution phase. When truth begins to show. Price can no longer break the previous high. Volume becomes erratic. The first big drop appears, then a weak bounce. Crowd psychology. Confused, doubtful, but still hopeful. Smart money, fully out. Now preparing for a move in the opposite direction. Many traders still hope for a bounce. But it doesn't come. Backhand index pointing right. This is the death trap zone. Holding longer only deepens the loss. Backhand index pointing right. A skilled analyst isn't stubborn. They shift their bias to the sell side. 6. Sharp decline phase, raw truth and broken emotion. Price plunges. Volume spikes in the downward direction. Fear takes over. Everyone wants out. Crowd psychology. Panic, capitulation, surrender. Smart money starts eyeing the next accumulation zone. The cycle begins anew. End of chapter 6. When you read emotion, you side with the winners. Market psychology isn't abstract. It's printed in every candle, every volume bar, every price zone. Each phase of a trend is a chapter in the book of emotion. And once you learn how to read it, you no longer have to guess. You just need to hear the whispers the crowd ignores and act before they even know what's happening.